the conversation around interest rate hikes is usually in 2 or 3 waves. The most common one is when you talk about how your loan rates will go up. So clearly, there's no doubt about it. Get ready to pay more EMIs for your home loans as the Reserve Bank of India has increased the repo rate by about 50 basis points to tame inflation. This is the second increase in the key rate in less than 2 months. The repo now stands at 4.9%. However, the middle class will continue to be impacted. The RBI expects inflation to remain above 6% till December and 6.7% for the whole financial year. Now, the question is that how will this really impact you? First, let me go across and play out for you the soundbite from RBI Governor Shetty.
The CPI headline inflation in April registered a further sharp increase to 7.8%. It was the fourth consecutive month when inflation touched or was above the upper tolerance level of 6%. The surge in headline inflation was seen across all major categories. The global geopolitical situation remains fluid and commodity markets remain on the edge, rendering heightened uncertainty to domestic inflation outlook. Certain positive developments on the prices front in recent weeks may help to ease the acute price pressures to some extent.
Now, with interest rates moving northwards, your loan repayment is set to get even costlier. Already, banks have passed on previous rate hikes that were announced in May. And now, with the rates hiked to 50 basis points, your EMIs will go up. My colleague Alex Matthew has this report on the implications of another rate hike.
The policy rates have been hiked as expected, and it's at the higher end of the expectations. The repo rate currently stands at 4.9%, and that means that your loans, home, car and personal loans, will be heading higher by 50 basis points. Now remember, if you're on a benchmark linked rate, your interest rate will be changed relatively quickly within 3 months. If on the other hand, you're on the MCLR linked loan, it'll take longer than that. Now, with the rate set to go up on your loans, you'll have two choices, either to raise the EMI or to increase the tenor of the loan. Let's look at what these choices imply. I've taken a home loan with an example of a principal of outstanding of about 50 lakh rupees and a current rate of 7.4%. That's payable over 15 years. That's 180 months. Now that's going to go up to 7.9%. Let's look at what happens if you increase your EMI. You'll have to pay 1,427 rupees more every month, and that will increase your interest cost over the duration of the loan by about 2.6 lakh rupees. Now, in most cases, your lender would prefer that you increase your tenor instead. And let's see what happens if you do increase your tenor. If that is your choice, your EMI, and we'll go to the next slide because that's what it's indicating, your tenor will go up by as much as 11 months. And that will take your interest cost higher. In fact, let's change to the next slide because that will indicate where it's moving. Your tenor increases, as I said, by 11 months, and that increases your interest cost by about 5.1 lakh. And this is nearly double what you would pay if you had increased your EMI instead. So if you have the ability, it is always more beneficial to increase your EMI. Bear in mind that in some cases, you won't have a choice. If you're 45 years old, for example, in our example, an increase in the tenor would mean that you're paying an EMI beyond the age of 60, and that's not something that a lender would prefer. And one last point, if you're at the start of your loan repayment cycle, it's always a great idea to try and prepay as much of your loan as possible because rates could in fact go up further.
All right, so how do you survive this situation of inflation? Pankaj Mathpal, MD, Optima Money Managers, with me on the show. Mrin Agarwal, Founder Director, FinSafe India, speaking with me today, as is Adhil, Shetty, CEO, bankbazaar.com. Adhil, great to see that smile. You're looking happy, even though savers perhaps are not, or people who have to pay loans. Now, my question to you is very simple. Should we really look at the 6.7% as the inflation hit, or should we account for the fact that the CPI does not reflect all of our costs, isn't it? You know, an average, say, salaried middle class urban Indian is also spending on things like going out to eat, entertainment, holidays, etc. How much is inflation for them, And what does it mean if your income doesn't grow by at least that much this year? Adhil, let me come to you first.
Great question, Tamanna. So I think the fact remains that while the CPI is calculated on an average basket of goods, that prices are increasing. I think if you're in the urban middle class, you have seen, the price of numerous items increase. Like the Reserve Bank governor called out, and you called out earlier, CPI inflation is over 7%. I think it's very clear to us that it's in everyone's interest. It's in everyone's interest, whether you're a consumer, whether you're a manufacturer, whether you're someone who's a stakeholder in the market. It's in everyone's interest that this inflation come under control. Now, what is control? The RBI itself has a set target. So they say 4% plus or minus 6%. So the RBI and in the country's larger interest, we need to figure out how to get this within bound, which is 6% by the end of this financial year. And I think that's what the RBI governor is talking about, saying, can we take front-loaded moves now? Can we take decisions now such that by the time December, January rolls around, right, CPI inflation is below 6% and consumers have a sense of how they can plan their financial lives going forward, because no one likes this kind of volatility.
Yeah. Pankaj Mathpal, I want to just underline the income inflation sort of ratio. Now, the Aeon 2022 salary survey says that it be the highest hike in 5 years on an average, which could be between 9 and 10%. Now, I don't know how many people watching this are sure that they'll get a 9 to 10% hike, but even if they did, and if I count inflation at about 7%, that means you're making 3% more, if you're lucky. Can this be enough for any, middle class Indian who wants to save? What does it mean in real terms?
Tamanna, see, first thing that the inflation of 6.75 is not the right thing we should consider, because when we write our budget or we talk about financial planning, see, the food inflation, medical inflation, education cost, that will be higher than the 6.75 if the general inflation is 6.75. So considering that fact, one has to plan. Either the income has to go up or your expenses have to come down. So as you said, that 9%, 10% increment in your salary, but that is also not everywhere. And apart from that, if you say the 9% hike also, I think it will be difficult to manage within that. So everyone should relook their financial plan, should revisit the household budget and plan accordingly. So, and this time means maybe that going forward, though for some time we'll expect that inflation will remain like this, but maybe that whatever you have saved in past, that will be able to help you. But things are difficult, no doubt about that, because one thing, there is no increment in the income, and second thing, as I said, that expenses are increasing by manifold. So one has to be ready for that, and most important, that the household budget should be revisited.
You need to save more, you need to spend less, and you have to be ready to eat out of your savings. Now, this is the dangerous part. Mrin Agarwal, I want to come to you on this. So, people are not really understanding this. When they look at this headline figure, 6.7%, or they look at a 50 basis point rate hike, what does it mean for them? It doesn't just limit you to the impact on your EMIs, isn't it?
And I think, we put a lot of emphasis on the loan rates going up and the EMIs going up. But I think somewhere savers and investors need to start focusing on what is happening to their investments. So point number one, what's happening to their savings rate, which is what also Pankaj spoke about, that you need to look at your budgets. You need to do something about either increasing your income or reducing your expenses. But I think more importantly, you need to look at where are you investing, and is that also beating inflation? Because when you look at the household savings numbers, you see a very low allocation to equities among Indian households, right? So a majority of the allocation is towards deposits and traditional products, which actually do not beat inflation. So I think it's very important to also look at where have you invested, because your income can probably grow that much, but I think And on a longer term basis, obviously this year looks really tough, but on a longer term basis, certainly you need to look at figuring out how to get your investments and your savings to grow.
Adil, what's the average FD rate? Right now, I saw 5.5 as the highest on the SBI website for the longest tenor. What is the average that you would get unless you're a senior citizen?
It's between 5 and 6. I think basis today's repo rate hike, right? So that might move up by 0.5%, but it was between 5 and 6. So now it's probably going to be between 5.5 and 6.5%, and this is pre-tax.
Exactly, it's pre-tax. So that means any savings that you're doing in these traditional methods, which are supposed to protect your capital, is not really helping you at all. You're not actually making any money. Adil?
Yeah, because you're losing 30% on the tax outflow. I think I want to pick up on a point Mrin just brought up, right? I think that this is a time where people should also stay calm, because this is not the last of the rate hikes, right? So if you look at all the views that are coming out there, there's a vast majority of people who believe that it's not going to stop at 4.9% at the repo. This is going to be 6% in the next 12 months. So I think it's also important to just realize that these cycles come and go. But like Mrin said, when you invest, right, you're investing with a certain objective in mind. So, equities over the long term, right, 5 to 10 years, always tend to give you high quality returns. India has some great index funds wherein you actually buying the market. And I'd say at this point in time, if you have equity investment, this is the time just to hold on, right? You should have that patience to wait 5-10 years to get the good returns you can. If you're thinking about debt, right, it's probably a good time not to lock in for the long term, because like this repo rate increase happened, another will happen. So you might find yourself locking in at a rising cycle. So I think the advice, if you're doing debt, is consider shorter term debt instruments.
Just a follow up on that. What has been the best performing mutual fund return or the average mutual fund return? Everyone says equity, equity, equity. But Adil, since you have all of this data, what has been the kind of returns on mutual funds? Because most average investors, that's the route they take. And then, they're also paying fees to fund managers, etc. What has been the return there?
So see, Tamanna, that's a difficult question to answer, not because I don't understand you, but because it looks at what horizon are you looking at? Is it 1 year? Is it 3 years? Is it 5 years? Is it 10 years?
No, let's peg it to 6.7%, because I don't know what inflation is going to be next year. I'm starting this conversation from a figure that the RBI has put out today at 6.7%. At the end of the year, FY23, that 6.7% might become higher, it might become lower. As of today, that's the number I have. And the peg of this conversation is, can you beat 6.7% at least? So in that context, over the last 1 year, has the average mutual fund given you 6.7%?
So I think the question also needs to be saying, what has the market given you over 3 or 5 years? Now, I don't have the data exactly as to what the market has given in the last year, but what I can tell you is the expectation of investors is that if you invest in an index fund over a 5-year period, you should look to make something close to 10%. That's my view. I'd be happy to hear what the other experts
All right.
think.
So, this is interesting, and not to put Adil or anyone on the spot, but I think we need to understand this, because we say this to our viewers in a blanket fashion that, okay, put your money in equity. Equity is going through some very turbulent times right now. So, Pankaj, I want you to come in on that point. Is it as simple as this, that, your FDs are not going to give you much, put your money in equity? Not everyone understands it. People go through mutual fund route. Have mutual funds performed that way in the last year?
Tamanna, these two are different things actually, inflation and investment. If we talk about the equity, that's for long term. Say last 1 year, if I talk about last 1 year, some of the funds have delivered, say 8 to 10% return as well. But if you see right from the January till now, most of even indices have given negative returns. So in next year also, next 1 year also, I expect that markets will remain very volatile. So if we are talking about the how to manage next 1 year with this inflation, so that will not help. See, definitely markets are down. This is a good time to invest in equity, but for long term. It's a time for accumulation. But if we are talking that right now your income has not gone up and expenses have gone up, how to manage that? It will not be helpful in that. So right now, whether it's the FD or your debt-oriented mutual funds, equity definitely for 1 year. I will not suggest even if your investment horizon is only 1 year and you want to invest
I
for.
understand where you're coming from, that no one should invest only for 1 year. But you know, this is an apple to apple. By that point, I should not be looking at FD rates at 5.5% right now. They will go up. But you have to benchmark somewhere. Mrin, you want to come in on this debate?
I'll tell you honestly, I would say that I think people have to get ready for a very difficult year. It's very difficult to say that an FD will give you 6%, inflation is at 6.7. So is equity the choice? Equity is the choice, provided you can hold for the long term, it ties in with your goals. Certainly on a 1 year, 2 year perspective, I really don't think that there's anything that's really going to beat inflation. So I think that's the reality at this point in time that people need to accept. And clearly you have to tie in your investments with your goals, because that's another thing that a lot of people don't do, right? I mean, everybody invests in an ad hoc fashion depending on what's doing well. But what you need to do is go back to the drawing board. Pankaj talked about the budgeting piece, but I think it's also really important to go back, look at your investments that you've done, and really see, do they really tie in with your goals? Can you hold them for the long term? And you have to accept that this year, maybe next year, I don't know, depending on how inflation moves and how interest rate moves, we are in for a couple of difficult months or maybe year.
All right, so let's break it down then. Let's break it down and start with telling people what they can do. Adhil, let me come to you first. What would be your recipe right now for those who have joined us on the show, are watching through, and at this point are wondering, okay, all of this is fine, but what do I do?
Okay, if you allowed me to give one suggestion to the viewers, Tamanna, it would actually be on a point Alex covered, which you just played. Because your repo rate has gone up by 0.9%, right? You're going to end up on a 50 lakh loan, 20-year loan, paying 50 extra EMIs. If you get a bonus this year, use that money to prepay down the principal of your loan and pull back the tenor. I'd say that this is my single most important advice we're giving people at Bank Bazaar, saying if you have any kind of extra resources, right, pay back or prepay your loan so that the extra EMIs which have now crept up get nullified.
Okay. Pankaj, you want to elaborate on the point that you made? First of all, people need to start looking at their budget. And this is a bit of a contradiction, because people after 2 years of pandemic now want to spend. So when we tell them, look at your budget and cut your discretionary expenditure, this is the time people are planning that holiday, or, are loosening those purse strings because they couldn't get out for so long. Is this the time for them to hold on even more?
I agree with you that people have been waiting for long to go out, but the situation is something that it is little difficult. So considering that fact, if people have saved money enough in the past, which they can use now, so that is one choice. But otherwise, definitely they should wait for some more time. Second thing, how to control their expenses, how to curtail expenses. See, like Adhil gave a very good example that you increase your EMI or pay some make some part payment so that your tenure does not extend. You are able to repay your loan within that time frame. But the problem is, at this point of time, it is difficult for people to manage their household expenses. It will be more difficult to pay more than the planned EMI. So in such case, they may wait for some time for this 1 year. Next year onward, when the income increases, inflation comes down, it may be easier for them to pay a lump sum amount towards the home loan. So such thing can be planned. But right now, for 1 year, I'll say that your expenses should be lesser than what you planned earlier. Then only it will be easier for you to manage your time.
Mrin, your advice to people who are watching?
Well, I would agree with what Pankaj is saying. You need to really look at your expenses. I have always advocated that you need to have a discretionary expenses budget, which is your fun expenses budget. So certainly try to carve that out so that, you know, you still have the fun. But yeah, I think it's the year where you will need to cut down. Another thing that I would like to point out is that while we're talking about the 6.7 number, and I think Adhil and Pankaj spoke about it, that the inflation on some of the things that we're saving for is actually close to 10%. So look at inflation on children's education.
Right.
So I would really come back to the same point that I made, that I think it's really important for people to look at where they have invested. Have they invested as per their goals? And are they really thinking about the fact that where they have invested is really going to beat inflation and grow to an amount that's really going to help them with their goals? So I think it's important to get back to the drawing board, look at your exposure, try to increase your equity exposure. The typical exposure most people have is about 5 to 10%. Maybe you need to bump it up to 20, 25% at least to tide over this.
Yep. At least start by asking the right question. And why that 6.7% figure is important, because it's, I think, a base benchmark of how expensive everything is going to get. Like Mrin said, things like education, schooling, dining out, etc. Has probably become even more expensive. So figure out how you can beat inflation. Ask that question first and then maybe go backwards from there. Thank you so much to all of you for joining us today. Just a quick programming reminder, we're talking with 3 economists